Part 2 of irrecoverable debts. Distinguish between an irrecoverable debt and a provision for irrecoverable debt. Calculate and record irrecoverable debts and provision for irrecoverable debts in the books of accounts. Key vocabularies: provision for irrecoverable debts, irrecoverable debts, debit, credit, credit sales, trade receivables, current assets, income statement, expenses, other income, statement of financial position, increase in provision for irrecoverable debts, decrease in provision for irrecoverable debts. Today's learning objective is to explain why it is necessary to provide provision for irrecoverable debts. You sold goods on credit to X, Y, Z, L and M. So let's answer the 8 questions which is on your left side. And let's try to answer the extended task as well. Who are these stakeholders to your business? Can you identify the double entry for credit sales? What balance does question 1 answer have? What balance do sales have? Will question 1 answer increase or decrease during credit sales? Will sales increase or decrease during credit sales? What balance do irrecoverable debts have? What balance do provisions have? Take few minutes to answer these questions. Now, let's look at the answers. Question 1. Who are the stakeholders to your business? They are trade receivables. Double entry for credit sales, debit trade receivables and credit sales. Always remember that the debit entry comes first. What balance does question 1 answer have? Trade receivables have a debit balance. What balance do sales have? A credit balance. Will question 1 answer increase or decrease during credit sales? Trade receivables increase. Will sales increase or decrease during credit sales? Sales increase. What balance do irrecoverable debts have? Debit balance. What balance do provisions have? A credit balance. Extended question. Your business has a doubt that few of the trade receivables will not pay the amount they owe. How will you record this in accounts? You prepare a provision for irrecoverable debt account. X, Y, Z, L and M are trade receivables. X owes to pay 100, Y 60, Z 250, L 500 and M 420. What's the total of the trade receivables? 1320. You add up 100, 60, 250, 500 and 420. What happens to the trade receivable balance if the payment will not be received from M? What would be the value of the trade receivables in that case? Means the net trade receivables. M owes to pay 420. If he becomes irrecoverable, in that case, you have the total value of trade receivables 1320. Take away the amount which M owes to pay, which is 420. Therefore, the net trade receivable balance is 900. Can you specify an account we can transfer the amount being unpaid by trade receivable M? That's your irrecoverable debt account. Can you guess the double entry for irrecoverable debt? Irrecoverable debts debit, trade receivables credit. Calculate 10% of the net trade receivables for provision for irrecoverable debts. So you can see your net trade receivables are 900 times 10 over 100 gives you 90. Now, a summary of the discussion that we had. 1st of Jan 20, trade receivable balance 1320. They didn't specify any opening balance for irrecoverable debt. 31st 12/20 trade receivables worth 420 were considered as irrecoverable. 31st 12/20 consider provision for irrecoverable debt for remaining trade receivables at 10%. You are expected to enter the opening balances to the ledgers, post the double entry to the ledgers, balance the ledgers and show the impact in final accounts, which are income statement and statement of financial position. Now let's see how to first record the entries in trade receivable account and irrecoverable debt account. You start with posting the opening entries. So 1st of Jan 2020, balance BD 1320 on the debit side. Irrecoverable debt, there isn't any opening balance. So you mark it 0 or you can ignore. Now let's post the double entry for irrecoverable debt. You debit irrecoverable debt account and credit trade receivables. 31st 12/20 in the trade receivable account on the credit side, opposite accounts name irrecoverable debt 420. Whereas irrecoverable debt account on the debit side, 31st 12/20, opposite accounts name trade receivables 420. Now we are going to balance the trade receivable account. Trade receivable balance goes to statement of financial position. Therefore, ensure you write it as balance carried down, brought down. Debit side is greater, bring it to the total. Find the difference between the total and the credit side 420. Therefore, you get 900. 31st 12/20 balance carried down. And write it on the opposite side, 1st of Jan 21 balance brought down 900. Now let's balance off irrecoverable debt account. Debit side is greater, bring it to the total. Take away 0 gives you the same answer 420. 31st 12/20 income statement under expenses. Now let's see how this reflects in an income statement and statement of financial position. Under income statement expenses, irrecoverable debt value of 420 will be entered, whereas in the statement of financial position, under current asset, the net trade receivable balance, which is 900. Now we are going to account for provision for irrecoverable debt. So we already had done the calculations for provision for irrecoverable debt. So we calculated which is worth 90. First you find out if you have any opening balance. 1st of Jan 20 balance brought down 0. For the current year, you calculated a provision for irrecoverable debt worth 90. As you can see in the question, the closing balance of trade receivable is 900 and we calculated 10% of it. Opening balance in the provision for irrecoverable debt 0. And for the current year, we calculated 90. Write that on the credit side as 31st 12/20 balance carried down above the total. And bring it down on the opposite side. 1st of Jan 21 balance carried brought down 90. Now let's balance off the account. Debit side is greater, bring it to the total, take away 0 gives you 90. Therefore, you transfer it 31st 12/20 to income statement under expenses, which is worth 90. And then you write this in the statement of financial position as well. Let's see how these entries would look like. As you can see here, the closing balance of trade receivable, net trade receivable is 900. You post this in your statement of financial position. Whereas there is an increase in irrecoverable debt, which should be shown under expenses in the income statement as 90. Increase in provision for irrecoverable debt. Then you enter the net trade receivable amount and the closing balance of irrecoverable debt, this 90 should be reflecting in the statement of financial position. So less provision for irrecoverable debt worth 90. Therefore, now your net trade receivable in statement of financial position is 810. So this is how we account for trade receivables, irrecoverable debts, and provision for irrecoverable debts. In our next lesson, we will be doing a question with an opening balance on the credit side for provision for irrecoverable debt. So this is an increase in provision for irrecoverable debt. So we'll be working on a decrease in provision for irrecoverable debt in our next session.